Joining us now is Richard Bernstein, Advisor's Deputy Chief Investment Officer, Dan Suzuki. Dan, great to have you back on the show. What do you mean by that? Why is this a mirror image of last year?
Well, if you just look at what worked and what didn't work last year, it's the exact opposite of what you've seen this year. And if you look back at historical initial rallies, coming out of these big sell-offs, this is pretty typical stuff. So I don't think that people should be reading too much into the composition and leadership of this market. I think that's kind of always how these bounces go, but it doesn't necessarily make them sustainable. I think ultimately, you got to come back to fundamentals. And if you think about profits, if you think about liquidity, those two things are still worsening. And that suggests to us that it's a little bit premature to be positioning for this big recovery when we still don't know how far and how deep or how long this earnings recession is going to go.
You sound like you're very cautious as far as equities are concerned. So if that's the case, how would you be counseling investors to be positioned right now?
Well, Morgan, I think you sort of alluded to this in the intro. I think it really depends on your time horizon here. I think if you care about the next 5 to 10 months, then the fact that we're in a profits recession that's happening, I think tells you want to be focused on high quality defensive assets. When things go wrong, this is sort of the macro backdrop when things go wrong. Now, if your time horizon is longer than that, say 5 to 10 years, then I think you can be a lot more optimistic. But I think the key is you don't necessarily want to be optimistic on the prior cycle leadership. I think you take out prior cycle leadership like U.S. large cap growth, innovation, technology, and you take out the defensives. The entire market is pretty fair game. I think everything out there trades cheap, and a lot of those areas are actually putting up better and more resilient earnings fundamentals than the areas of the market that people are chasing here.
Yeah, I mean, U.S. markets are contending with a number of bigger, more macro issues, whether it's this debt ceiling drama that continues to unfold in real time right now with the clock ticking, or whether it's all the regional bank angst, among other things. Is the U.S. still the best place to be parking money right now and putting it to work, or do you look internationally, especially when you have Japanese and German stocks, for example, hitting fresh highs?
Yeah, Morgan, I think that's exactly the point. I think that the U.S. market is where everybody wants to be because people tend to chase performance. And that's been the leadership for the last decade or so. And I think that's the misnomer, because if you look at relative fundamentals, the rest of the world is actually showing more resilient earnings fundamentals. Yet they trade at discounts in the neighborhood of anywhere between 20 to 50% cheaper than the U.S., with a lot less concentration to the areas that I think put the market at huge concentration risk here.
Okay. Dan Suzuki, thank you for joining us.